It's 12:58 a.m. You weren't planning to spiral. You just opened one listing. Just one. Now you're deep into page 7 of homes you technically could buy. Every house that isn't visibly collapsing? $500,000. The description says cozy. The photos scream renovated sometime during the Bush administration. The countertops are laminate pretending to be granite. The carpet is beige in a way that feels emotionally exhausting. The backyard is described as low maintenance, which is realtor code for approximately the size of a yoga mat. And yet, confidently, it's labeled a starter home. You start doing math in your head. Quietly. Carefully. You compare your salary to the price. You divide. You multiply. You question your career choices. You wonder if everyone else secretly doubled their income without telling you. Or maybe the housing market has collectively lost contact with reality. Here's the truth most people won't say clearly. It's not you. It's the math. And the math is brutal. My name is Nick, and today we're going to walk through something very simple and very uncomfortable. We're going to calculate who can actually afford a $500,000 house in 2026. Not who can get approved. Not who can technically sign the paperwork. Not who can scrape by. But who can buy one and still live a financially stable life. Because qualifying for a mortgage and living comfortably with that mortgage are two completely different calculations. And if you appreciate honest, math-based conversations about money, the kind that don't rely on hype, consider subscribing. There's a lot more where this came from. Now let's start with the foundation. In many U.S. markets, $500,000 is no longer luxury territory. It's entry level. It buys you a modest home, roughly 1,200 to 1,500 square feet, in a neighborhood that is neither elite nor distressed. In cities like Denver, Austin, Nashville, parts of Florida, or anywhere within commuting distance of a major metro area, $500,000 is simply what the market demands. Now compare that with income. The median household income in the United States is approximately $84,000 per year. That means the typical household earns $84,000 and is expected to consider homes priced at 6 times their annual income. Historically, sustainable housing markets hovered around 3 times annual income. 6 times is not a minor shift. It's a structural imbalance. And yet the messaging everywhere tells you it's normal. Mortgage brokers say you're approved. Agents say this is just how it is now. Social media says everyone's doing it. Your parents remind you they bought younger than you are now. So what's happening? The definition of affordable has been quietly redefined. Let's start with the down payment. The traditional benchmark is 20% down. On a $500,000 home, that's $100,000 in cash. The median savings account balance in the U.S.? Around $8,000. That's not a slight gap. That's a chasm. Even if a household earning $84,000 somehow saves 10% of gross income per year, about $8,400, it would take nearly 12 years to reach $100,000. And that assumes housing prices remain frozen during that time. Which they won't. So most buyers put down 5% or 10%. Let's say you manage 10%. That's $50,000 down. Loan amount, $450,000. With current interest rates in the 6% to 7% range, principal and interest alone land around $2,750 to $2,850 per month. But that's only the beginning. Add property taxes. Depending on location, $500 per month is a conservative estimate. Add homeowners insurance. Around $300 per month. Add maintenance. The general rule is 1% of home value annually. That's $5,000 per year, or about $417 per month. Add PMI because you didn't put 20% down. Roughly $300 per month. Let's total that. Mortgage, $2,850. Taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. Total monthly housing cost, approximately $4,367. And that assumes nothing major breaks. No roof replacement. No HVAC failure. No surprise HOA assessments. Financial advisors often recommend keeping housing costs below 28% of gross income. Banks may approve loans up to 43% total debt to income. Reverse the calculation. If $4,367 represents 28% of your income, you need to earn about $187,000 per year. Even using the more lenient 43% threshold, you'd need around $150,000 annually. Only roughly 10 to 20% of U.S. households earn $150,000 or more, which means the majority of households cannot comfortably afford a $500,000 home under responsible financial guidelines. That's not pessimism. That's math. But houses are still selling. So who is buying them? Some households have dual high-paying incomes. Some receive significant help from family. Some are stretching themselves thin, betting on future raises or assuming stability will continue uninterrupted. Let's look at a realistic example. A dual-income household earning $160,000 per year. After federal taxes, state taxes, payroll taxes, and modest retirement contributions, take-home pay may be around $9,500 per month. Subtract $4,367 for housing. Remaining, $5,133. Now add standard living expenses. 2 car payments, $800. Car insurance, $250. Fuel, $300. Student loans, $600. Health insurance premiums, $400. Groceries, $800. Utilities and internet, $450. Remaining balance, $1,533. From that $1,533 must come clothing, medical copays, home repairs beyond routine maintenance, emergency savings, childcare, entertainment, travel, future retirement investing beyond minimum contributions. Housing is consuming nearly half of take-home pay. This is what being house poor looks like. It looks like checking your bank balance before grocery shopping. It looks like delaying maintenance. It looks like financing unexpected repairs. It looks like anxiety attached to every financial decision. Now imagine this scenario at $120,000 income, or $100,000, or the median $84,000. At median income, a $500,000 home is not tight. It is financially unrealistic without extraordinary risk or external assistance. And here's the part that makes this especially complicated. The system is not designed to protect your long-term comfort. Sellers price based on comparable sales. Banks approve loans within acceptable risk parameters. Real estate agents earn commissions when deals close. No one in that chain is rewarded for telling you to slow down. Once you sign, exiting the decision is expensive. Selling early can mean losses. Walking away damages credit. So here's the real question. Will owning this house improve your life, or dominate it? There is no prize for buying a home you cannot sustainably afford. There is no medal for stretching to your absolute financial limit. Wealth is not defined by homeownership alone. Wealth is defined by margin. Margin to invest. Margin to save. Margin to absorb shocks. Margin to live without constant financial stress. If a home purchase eliminates that margin, it is not building wealth. It is compressing it. Homeownership can absolutely build wealth when aligned with income, stability, and long-term strategy. But stretching to the maximum loan amount because you're approved is not strategy. It is risk disguised as ambition. If you're currently considering a $500,000 home and your household income is significantly below $140,000, pause. Not emotionally. Mathematically. Run full projections. Include every expense. Consider job stability. Consider lifestyle impact. Maybe the better decision is a lower price point. Maybe it's renting while investing aggressively. Maybe it's relocating. Maybe it's waiting. There is no failure in choosing sustainability. Housing prices have dramatically outpaced wage growth over the past few decades. The disconnect is measurable and significant. You cannot budget your way out of a structural imbalance. You cannot side hustle your way into affordability if your baseline numbers don't align. The real question isn't, can I get approved? It's, will this decision improve my financial life? And sometimes the most mature financial decision is not stretching further. It's stepping back, doing the math, and refusing to confuse approval with affordability. If this breakdown helps you see things more clearly, and you want more conversations like this about money, markets, and long-term strategy, consider subscribing. Because the housing market will keep pricing homes at $500,000. Banks will keep approving loans. But you don't have to participate in financial strain just because it's common. Sometimes the smartest move isn't buying. It's choosing stability over pressure. And that decision doesn't make you behind. It makes you informed.